Hi, I'm Clayton Johnson with Squire Wealth Advisors, and today I have with me Wayne Barbin, who's also from Squire Wealth Advisors. Wayne, thanks for joining me.
Happy to be here. Thanks, Clayton.
Yeah, so we wanted to spend a few minutes to just talk about what happened in Q1 of 2024 in the markets and just offer our perspective. So Wayne, to get us started out, can you just tell us a little bit about what happened this last quarter, how the markets did, and what that means for investors?
Yeah, it was actually a fantastic quarter for the markets if you're looking at growth, right? Just about all areas of the equity market were up to one degree or another. So we were really happy with that. Yeah. Like most years or most quarters and years, we saw some fluctuations in different asset classes. Some areas did better than others, and that's fairly typical. If we look at how well U.S. stocks did, that's mostly on the large growth area. They did tremendously well. That was almost up 10%. And so we saw some really good growth there. International emerging markets were all up as well. Lagging behind, but still positive, were small and small value. Historically, that hasn't been the case. But anyway, it just happens to the market tends to go up, but not every asset class at the same pace. And so that's what we saw this quarter. A lot of that had to do with the hope, I think, that is there that as inflation ebbs a little bit, it's come down significantly from the highs that it was at. We're seeing that there's the idea, at least, that they'll start lowering interest rates soon. And that's what's kind of keeping the market from continuing to ascend, is that concern that the economy's still doing well enough and there's still some inflationary pressures that we really aren't going to see them lower interest rates for some time. And you'll talk about that a little bit later with the bond market potentially.
Yeah, and one thing I'll point out too, I mean, as you mentioned, large growth led the way in this quarter at about 11.4% in large growth.
Yeah, that's fantastic.
It's great. You know, we're not complaining about great performance like that. We adhere to a philosophy that we tilt towards small value often in our portfolios. So we're always looking for when that premium shows up at roughly 2.9%, about 3% this quarter, which is still good, just relative to large growth. Usually. Yeah. One thing I do want to point out about small value is oftentimes that'll show up in small blips, right? Where small value does really well over a short period of time. And if you follow a value investing strategy and a small value investing strategy, it's really important to stay in the market, right? Because you can miss those important days when the markets do recover and small value does exceptionally well. So one of the things I do want to also bring up here, we're looking at a slide here about the relative cost of earnings through time. I think this is an important chart to look at, and you and I have talked about how this is one of your favorites, really, and what it means for investors, what it means for our portfolios, as far as where things stand in relation to their PE ratio currently compared to where they are on historical averages. So can you tell us a little about what this chart is saying, Wayne, and why that's important to understand?
Yeah, you're right. This is probably my favorite chart because I think it tells a great story this quarter. If you look at the chart, it compares U.S. market equity, which is kind of the large growth and large value, U.S. small value equity below, and you see those graphs. There's a couple of things to note. One is U.S. market equities at 21.4. That means price to earnings ratio. The price is 21.4 times a dollar of earnings, right? So it takes $21 of price for a dollar of earnings as a comparison.
Real quick, Wayne, just to interrupt you for a second. The chart we're looking at here actually says 23.5. So I think 21.4 was from maybe a quarter ago. 23.5 is what we're looking at today. But it's the same message. It's the same message. It's the same idea.
It is. It's the other one. But yeah, so if you look at the U.S. market equity, the U.S. small value equity, it takes a lot less dollars to buy a dollar of earnings in small value as it does to large value. The same is true of international, and specifically international small value. It's only $8, or, in this graph, it's a lot fewer dollars to buy a dollar of earnings from those companies than it is here in the US. But more importantly, if you look at the end of that graph, you will see that for the large growth, it's actually much higher than the mean, the average that it's been, right? It's kind of overpriced, if you will, if you just consider the price to earnings ratio, the price compared to the earnings. And small value hasn't kept up. Now, over time, we expect those to kind of revert back to the mean. And so there is a little bit of a hint of maybe that area is a little overinflated and maybe the other one is a little bit underinflated. What that tells us is it may be a good time to look at those, look back at our portfolios, maybe do some rebalancing, take some of those that have done well, not everything, obviously. We want to stay invested in all areas of the market, all of those asset classes. But to take a small amount of that has done so well and reinvest it in some of that we expect to do better in the future as well.
Yeah, and that's a great point. One of the things that I like to think about is that the investor behavior tied to this point, right? I'm a frequent purchaser of items on Amazon, and one of the nice functions of Amazon, it'll tell you this item that you may be following, how the price of that item compares to its historical average. So if I'm following Aqua de Jo cologne and it's on sale right now and it's $20 less than normal, that's an opportunity for me to buy. And that's kind of what we're looking at here too, right? We're charting out the price relative to earnings and its historical average. I'm not going to go buy my product when it's at its most expensive point. Usually I'm trying to buy things for sale. Now, I think we all can relate to that. We're all looking for a good bargain on whatever it is. But for whatever reason in the investing world, we do the opposite. Like innately, we do the opposite. And so we have to check ourselves and make sure that we're not doing that. We hear about the Mag 7 or the best 7 companies, and we hear about this strategy and it's been doing really well over the last year, and it's just outperforming. And what that means is more money is going into it and it's becoming a more expensive strategy, and its price to earnings may be higher. And so I think we need to check ourselves sometimes when investing, make sure that we're not pursuing what's been doing really well over the last 12 months or the last 2 years or even the last 5 years, because it may be that the PE ratio is higher. And as reversion to mean often happens, that'll impact us negatively going forward. So,
yeah, exactly.
Were you going to say something, Wayne?
I was just going to say that, as we look at that, this isn't I don't know what the future holds, right? We just look back at the times when one's high and one's low, and you can look through that on those graphs, and it's just a time where you've seen that separation where one is below the mean, one is above the mean. I don't know when that's going to change or even if, but that's how we look at that, as maybe that's an opportunity to rebalance and just get your portfolio back in line with where we would expect that to be. Maybe it's an opportunity to sell high and buy low. Time will tell, but we would expect that to be the case.
Yeah. And then I want to just briefly talk about how bonds performed over the last quarter. As you can see on the chart, bond performance was negative for the quarter. There was a lot of expectation about interest rates dropping from the Fed. That didn't happen. There's an inverse relationship between bond prices and interest rates. As interest rates go up, bond prices go down. So if you hold existing bonds and interest rates are going up, then the value of your bonds are going down. On the short end of bonds, so those that you're for a year to 3 years, there was actually positive return. But long-term bonds, those from the 10 to 20 year range, you saw a larger negative performance. And that's pretty typical of the bond market. The further out you go on maturity or out on the yield curve, the more the price of the bond is going to fluctuate with changes in interest rates. And so to transition that to just where we're at with interest rates, we're still in an inverted yield curve right now. Although it's less inverted than it was in the past. Even the last quarter, we've seen improvement in the yield curve. There's still expected positive returns in the bond market, and it's improved for the long-term bonds as well. So just wanted to highlight a few of those points when it comes to fixed income. But this last thing that I want to talk about, Wayne, and just ask you about is what we refer to oftentimes as the Skittles chart or the quilt chart, where it shows us the diversification of various asset classes and how they performed in certain years. So why is this important when we look at our portfolios as a whole and consider what happened this last quarter, for example? Why is this important for us as investors to understand the principles behind this diversification?
I think the best thing we can do is we can look at this chart and realize there is really no rhyme or reason, no statistical way to put this chart together and say if this happens after this, that it really has no rhyme or reason to it, right? It just happens. But this is a review of what has happened over the last 20 years as far as which asset class performed better in each of those given years and how much it did to the good or to the bad, right? And so as you walk through this graph, what it tells us is oftentimes what was best one year is, if you look at this graph, the worst the next year, right? And so you really can't predict what next year or what the return of 2024 will be based on what 2023's was. It really gives us, I think, a really good idea of why diversification is so important, right? If you follow the white line or the white squares there, what they will follow is what kind of the average has been, what a 60% equity, 40% fixed income portfolio would be. That's kind of on the moderate to conservative side, right? And it compares it to a S&P 500 that's all equity, so you would expect that to be the highest. A few years ago, though, the S&P was not the highest. It's just that over the last few years, it has been in the top, near the top or at the top for 5 of the last 6 years. Well, that's brought that average clear up from where it was. If you look back at the beginning of the graph, you can see there's 4 or 5 years where it was below the mean, right? What it really tells us is just to diversify, have all of the asset classes that will even out some of the volatility that you wouldn't otherwise see, and try to get a good, I shouldn't say more stable return, but you'd still get a great return, specifically if you were, say, all equity, right? But this is a very moderate account that we're tracking in this particular graph. But we just cannot predict what's going to happen next year based on last year. And so what we want to try to do is to diversify into all of the asset classes and get that more even-keeled return over that time than what we would get. You don't get the best return, and you obviously don't get the worst return. You get somewhere in between, and yet overall your return would be really good.
Yeah, I like to contrast that white one with like the darker maroon one that's representing real estate. You can see that dark maroon one had a number of years where it's the top performing sector or asset class, but you also have a number where it's the bottom performing one as well. The white section doesn't have any top performing or any bottom performing. So depending on what you as an investor are trying to accomplish, and if you're trying to even out the volatility, then you do some kind of a blend. If you're just trying to shoot for the moon and get the most return possible, well, a 60-40 portfolio may not be right for you. We're not advocating or recommending any specific portfolio to people. Just to be clear on this call, we're just emphasizing that there's opportunity for diversification to minimize your risk, and you just never know what the next year is going to hold as far as which asset class. So our philosophy, what we often recommend is it's best to hold a large basket of stocks, of sectors, of countries, get a whole global portfolio, because then you can capture those positive returns when they happen, wherever they happen. We just never know, right? So, well, Wayne, I appreciate you joining me on this call and answering some questions about how the quarter went. So thank you so much, Wayne.
Oh, no, happy to. It's been fun. Thank you, Clayton.